Variable annuities are starting to look good again. No, not variable annuities. People start freaking out. I don't understand it. I don't understand. Just because it has this term annuity, people are like, yeah, it's crazy to me. It's kind of like, assault rifle. Define assault rifle. There's something that makes me scared. Well, a semi-automatic rifle makes you scared. Yes, because it's black and, scary. People go nuts for words. Crazy. Anyway, so I was reading this article today by my man Scott McKellop from 2011 from Financial Advisor magazine, Rethinking Small Caps, which is an article I got after reading I don't have his article up here. Michael Edison had written an article taking to task some guys who say small caps outperform always and everywhere, kind of. And he quoted from this article. So I'm reading this in an I'm reading online, and I saw this advertisement for this protective variable annuity. I said, let me check this out, because I haven't really looked much at variable annuities for a while. You may or may not remember this. So back in the late 1990s, there's a lot of animosity towards variable annuities in the academic field. The one guy named I don't know how you say it in Hebrew, Moshe, M-O-S-H-E, Moshe Milevsky, I think is his name, from University of Toronto or something like that. He had written some pretty scathing articles on variable annuities. And then some academics said, man, you got to look, because if you compare what's basically the arms race, what they're giving away for variable annuities relative to what you could get if you were buying your own option contracts, variable annuities are actually quite cheap for the benefits you get. And he did 180 degrees. Said, man, you're right. These are quite good. That changed. All right. In fact, we know that changed because a lot of variable annuity providers were basically begging their clients, say, let us buy you out of the contract. Let us buy you out of the contract, because they got over their skis in terms of the offerings they were offering. In fact, I used to sell some variable annuities, Ohio National and Pac Life. Those were fantastic. They're great. Should you buy it? That's up to you. But I used to sell some, and a big fan. But anyway, so what happened then for the last probably 10 to 15 years, the insurance companies just really started restricting their payouts and restricting the benefits they provided. I'm not sure about increasing their fees, but so it's been this kind of like ebb and flow. And I came across this one from Protective, and this is where I got my life insurance from, Protective. And this was interesting to me. Secure Pay Protector Optional Lifetime Income Benefit. All right. It offers guaranteed lifetime income as an annual benefit-based roll-up and access to top-rated investment funds. But here's what's interesting. They're back to using a 7% compounded annual income benefit roll-up. So let me just explain real quick how this works. With a variable annuity, there's two accounts. And I talked about this in my investment course, which if you haven't got, you're mistaken. You need to go to the Dubaduke and sign up for my investment course. Everything you need to know about investing. It's $200. If you don't like it, you get your $200 back after 30 days. So if you're not signed up for it, you're wrong, not me. You are wrong. I am right. But we talk about the variable annuities. We talk about index annuities. We talk about income annuities. We talk about all kinds of, not just that, everything. So there's two basic benefits here. You got your contract value. That's how much you put in and what it's worth, depending on market conditions, your contract value. And then you got your income base. Your income base is not really tied so much to the contract value. The income base says, look, we are going to grow at a certain income base each and every year. That way you can't outlive your income. Now your contract value is going to go like this, but your income base will always be like at least a minimum here, and it will go up hopefully, and I'll show you what I'm talking about. So there's two different things. Your contract value is how much money you can pull from your account. You say, I'm done with Protective Life. I can't stand that you voted for Sniffy Joe. I'm pulling my money out. I'm going to go put it in, I don't know, real estate, something like that. That's your contract value. That's your money, your cash value. How much is the account worth right now? Your income base, on the other hand, is a phantom account until you turn it on as an income stream. So let me show you what I'm talking about. In this case right here, we get a 7% compounded annual roll-up. Now, if you scroll down to number 2, you got a little asterisk here. First of all, it costs 1.4% for this what's called a rider, R-I-D-E-R. So it's not cheap. For every $100,000, you're paying $1,400 for this thing. But if on a contract, so this is interesting, so check me out. So hear me out. If on a contract anniversary, the contract value is less than 50% of the current benefit base, the 7% guaranteed growth will be suspended during that contract year, and the benefit base will remain unchanged. I'll explain that here in just a second. The 7% guaranteed growth rate will continue to be available for 10 years, essentially, until 10 benefit base increases have occurred or until benefit withdrawals have happened. So basically what they're saying is, we're just good for simplicity. Say you're getting a 5% rate of return on your money, just for simplicity, on your contract value. Every year, your benefit base is going to grow by 7% compounding, which means at the end of 10 years, you'll have a benefit base that is worth $200,000. That is not the money you can pull from the account. That's just $200,000 you can take a guaranteed income stream from. Now, your contract amount, if you're only getting 5% a year, hold on just a second. So you get $100,000. We're getting 5% a year for 10 years. That would be worth what? 162. So your benefit base in that case is worth 200,000, but your contract value is worth 162. Let me get the dog. In this case, at 162, if you were to take 5% a year off, that'd be times 0.05. That'd be $8,100 a year. But your benefit base, because it's growing at 7% a year for 10 years, will give you at least $10,000. But look at this. They got right here. This is 6% at age 65. Now that's for a single life. We go down to number 3. Withdrawal rate of 6% at age 65 is for a single lifetime payout. So that's probably 5.5% for a joint life at 65, which is more than your contract base, and it's guaranteed. I'm sorry, there's a benefit there. Yes, it costs you 1.4% a year. Yes, your variable annuity will never outgrow the S&P 500, excepting for the fact that the S&P 500 has no guaranteed income stream. The reason you get a guaranteed income stream is because you're paying for it. You're paying 1.4% a year. That's a big deal, man. So now your contract value, is with 162. You're like, I can take 5% a year off that. That's $8,100. My benefit base, on the other hand, is worth $200,000. I can take 5%, or in this case, with 6%, if you're a single guy or person that's 65 years old. That's $12,000 a year. That's a 50% increase on your income stream. Now, you can make an argument, I think is valid, that once you start taking that money out of your contract, I don't even know if you can say that, make that argument, but let's just say, once you start taking money out of your benefit base, you won't get any more growth on that. And I actually tend to agree with that, frankly. I doubt very highly that you're going to get any more growth once you're pulling 6% a year from a benefit base that's worth $200,000 with a 1.4% fee. I don't think you're going to get any more. You'll probably be stuck at 12%. But you have, $12,000 a year. You just don't know. I don't think you'd get more than that. But the same can be said about a stock fund too. You're like, well, I'm pulling 5% a year out. What's the likelihood that that's going to grow? I'm 50% behind in my stock fund at 5% a year. What's the likelihood that that will grow more than enough to outmatch the $12,000 I'm getting from the variable annuity? Not very high, and with a significant downside risk probability as well too. Very interesting to me. That's what I want. So what's the drawback here? Well, if your contract value is less than half the value of the benefit base. So now let's say my benefit base is $200,000, right? And then we're going to say my benefit base is $200,000 year 10. My contract value, and I just use this for example so you can kind of grasp it. My benefit base is $200,000. My contract value is $162, and then we fell 50%. A 50% increase minus 50%. Now I'm down to $81,000. They're not going to give me an extra 7% increase in my benefit base. So if the contract value is worth less than half of the benefit base, not very likely, but it could happen, they will stop giving you that 7% guaranteed roll-up for your income benefit. Now, they're only going to give you it for that 10 years anyway, so you're only going to get 10 years on this anyhow. So the way I look at it is like, unless you have a major market crash, and I'm talking major market crash, you put $100,000 into the contract value, your benefit base is increasing by 7% a year compounded, and we're talking a major, if the contract value is worth less than half of what your benefit base is, they're not going to give you that 7% roll up. That's not likely to happen. Just anything could happen, I grant you, but still not likely to happen. But then if that were to happen, they'd stop the increase on the compounded 7% annual. And they're only going to do that for 10 years. The most likely scenario is that your contract value will probably grow more than your benefit base. All right, so your contract value would probably, say $240,000. All right, so even if you had, after 10 years, I'm saying, so contract value at $240,000, let's just say you got $100,000 and we got 8% a year. present value, 8% a year, 10 years, and no payment. Yeah, so there your contract value is $215,000. So your contract value in that regard is $215, but your benefit base is $200. So now you're taking 5% off $215. That's still only $10,792, $794, with no risk, with no downside guarantee at all. However, the benefit base will give you $12,000 if you're single at 65, and I imagine it'll give you more the older you get too. Now, the cost of all this is probably going to run about 2.5%, 3%. We already talked about the cost because the investments that they have in here, right here, we already talked the 1.4% fee. I don't know what this right time thing is. I don't know if they see the fees on their investments that they have in here on the prospectuses, but usually probably run to 75 basis points, something like that. Then they also have the secure nursing home enhancement too. So I didn't even look at that. That's interesting. So that gives you a, 1 second. Qualify nursing home. The client must be confined to a qualified nursing facility, be unable to perform 2 of the 6 activities of daily living, or diagnosed with a severe cognitive impairment. Have not been in a nursing home 1 year before or after the purchasing of the Protected Lifetime Income Benefit. Proof of qualification is required for each contract year in which this benefit is claimed. So, and usually it's accelerated benefit that they'll give you some of the money that you would have had for the income for a nursing home or something. I don't know anything about the policy. I'm not licensed by these guys. I don't know anything about it. But I just know if we're going back to the time where we're getting a 7% guaranteed income roll up, and with in this case, a 6%, a single life at 65, that usually is going to mean it's going to be 5.5% for a joint life at 65, which usually means it'll be 6.5% to 7%, probably 6.5% for a single life at 70, probably means 6% for joint life at 70. I tell you, man, something to look into for sure. And who do you talk to? I don't know. I don't even know if Amar does variable annuities, but it might be something you revisit. You might want to revisit variable annuities. They're starting to. I like that. I like the fact that guaranteed income you can't outlive, because you just don't know, man. And what if we go back into another 1970s scenario? And you're going to want to get that guarantees, man. I could be wrong. I mean, there's been many examples where the market did much, much better than the variable annuity. And you're like, oh, yeah, but when the times it doesn't, you're like, yeah, sometimes better be safe than sorry. All right, God bless. Love your thoughts. See ya.